In closing, learning to read a company's financial statements is not optional if you want to invest successfully or advise high net worth clients. It's a discipline that pays dividends over a lifetime. The Balance Sheet Decoder is your foundation, a formula and mindset to cut through complexity and find truth. If you're serious about mastering this skill, I've developed a comprehensive course that goes far beyond today's discussion. It includes detailed case studies, interactive exercises, and advanced valuation techniques tailored for real investors. Don't rely on guesswork or hearsay. Empower yourself with knowledge and precision. Visit the link below to enroll in the course and transform how you analyze companies forever. Thank you for listening. This has been JM sharing 3 decades of experience to help you see what others don't. Now go decode those balance sheets and take control of your financial future. To truly excel at decoding balance sheets, you must become an expert in uncovering off-balance sheet items. These are financial obligations or assets that do not appear directly on the balance sheet but can significantly affect a company's risk profile and valuation. Common off-balance sheet items include operating leases, joint ventures, special purpose entities, and certain types of contingent liabilities. Companies might use these structures to keep debt or obligations hidden from plain sight and therefore appear financially healthier than they actually are. Take operating leases, for example. Historically, many leases were treated as operating expenses instead of debt, keeping liabilities off the balance sheet. This practice changed with the introduction of new accounting standards like IFRS 16 and ASC 842, which require most leases to be capitalized. However, not all companies have fully adjusted or disclosed the implications. As an investor, you should scrutinize the footnotes and management discussion for lease commitments. Special purpose entities were infamously abused during the Enron scandal to hide debt and liabilities. While regulation has tightened, SPEs still exist in various forms, especially in industries like real estate or structured finance. Understanding the company's relationship with these entities and the risks involved demands a forensic mindset. Joint ventures and partnerships might not be consolidated fully on the balance sheet. If the company relies heavily on such arrangements, you need to understand your share of risks and rewards. For instance, a real estate developer might have significant off-balance sheet commitments through joint ventures that could become liabilities if projects underperform. Contingent liabilities such as pending lawsuits, environmental remediation, or warranties may not be reflected as liabilities unless probable and estimable. However, the financial impact could be material. Reading the legal and risk disclosures is essential to estimate potential future cash outflows. Beyond the technical skills, successful financial statement analysis requires mastery over your own psychology. Human brains are wired with biases. That can cloud judgment and lead to costly mistakes. Let's explore some of the most common biases affecting investors. Confirmation bias. This is the tendency to seek or interpret information that confirms pre-existing beliefs. If you believe a company is a great investment, you might unconsciously downplay warning signs like deteriorating receivables or ballooning liabilities. Anchoring bias. Investors often anchor on a particular number or metric, such as last quarter's earnings or a target price. Overconfidence bias. Confidence is necessary, but overconfidence leads to underestimating risks and ignoring contradictory evidence. Herd mentality. Following what the majority is doing can be dangerous. If everyone is bullish on a stock based on hype, you might ignore the underlying weakening balance sheet. Availability bias. Recent or vivid information disproportionately influences your judgment. A flashy earnings beat might overshadow subtle signs of increasing debt. To overcome these biases, cultivate a disciplined approach, question assumptions, seek disconfirming evidence, and regularly review your analysis critically. Financial statements do not exist in a vacuum. Macroeconomic conditions profoundly impact a company's balance sheet and overall financial health. Interest rates. Rising interest rates increase borrowing costs, affecting companies with significant debt. Fixed rate debt remains stable, but variable rate debt rises. Inflation. Inflation can distort asset valuations, Inventory might be booked at historical cost but replaced at higher prices, compressing margins. Economic cycles. During downturns, receivables aging and inventory obsolescence tend to worsen. Conversely, in expansions, companies might leverage more aggressively. Currency fluctuations. Multinational companies face currency risk that can affect asset valuations and liabilities. Understanding hedging policies is crucial. Regulatory changes, new accounting standards, tax laws, or industry regulations can materially affect balance sheets. For example, changes in pension accounting. Even when you master financial statements, market prices do not always reflect intrinsic value immediately. Behavioral finance explains why. Markets are influenced by emotions, narratives, and cognitive errors. A company with a solid balance sheet might trade at a discount due to negative sentiment. Understanding this divergence helps you find opportunities and avoid traps. Contrarian investors often buy when fear drives prices below intrinsic value. Moreover, market participants sometimes misinterpret financial statements, focusing heavily on headline earnings without probing the balance sheet. For example, during the dot-com bubble, many companies had negligible tangible assets and negative cash flow, but soaring stock prices. Balance sheet strength became critical. Numbers tell a powerful story, but they don't capture everything. Integrating qualitative analysis enriches your understanding. Management quality. Leadership decisions affect asset quality and equity returns. A transparent, prudent management team is less likely to hide liabilities. Industry dynamics. Some industries naturally carry higher asset risk or debt levels. Technology has intangibles. Banks have complex liabilities. Context is essential. Corporate governance. Review related party transactions, auditor changes, or regulatory investigations. These factors can signal potential manipulation. Customer and supplier relationships. Concentration risks can affect receivables. A default by a key customer could impair cash flow. Let me share a real-life example illustrating the power of balance sheet scrutiny. In the early 2000s, a large retail chain appeared profitable. However, a detailed balance sheet analysis revealed red flags, rapidly increasing receivables, ballooning short-term debt, and a growing gap in book value. The company's inventory turnover was declining, indicating overstocking. Cash flow statements showed negative operating cash flow despite reported profits. Eventually, the company filed for bankruptcy, wiping out equity investors. This case underscores why decoding the balance sheet thoroughly is indispensable. In today's data-rich environment, leveraging technology can enhance your balance sheet decoding. Financial data platforms offer historical analysis. Tools like Excel macros, Python scripts, or specialized software can automate ratio calculations, flag anomalies, and visualize trends. Natural language processing can analyze earnings called transcripts and footnotes to detect sentiment shifts or unusual disclosures. Machine learning can predict distress. However, technology is a complement, not a replacement, for human judgment. Critical thinking and skepticism remain paramount. Use tools to augment, not replace. Mastering the balance sheet, decoder, and financial statement analysis is not just about short-term gains. It builds a foundation for lifelong financial acumen. You'll develop a sharper ability to assess risk, value companies accurately, and identify mispriced assets. This skill transcends investing. It's invaluable in all business. Moreover, it instills a mindset of curiosity, discipline, and critical thinking. In a world awash with information, discernment confers a competitive advantage. We've journeyed from psychological barriers into the nuanced art of decoding the balance sheet with skepticism and insight. We explored macro, context, and tech. The path to mastering financial statement analysis is challenging but immensely rewarding. It demands emotional discipline, intellectual honesty, and relentless curiosity. Remember, every financial statement tells a story. Your role as an investor or advisor is to listen carefully, ask the tough questions, and see beyond the surface. With the Balance Sheet Decoder as your tool, you can navigate complexity confidently. This is JM, encouraging you to keep learning and take control of your financial destiny.